Look, most people invest with their gut. They read headlines, listen to experts, make decisions based on what feels right in the moment, basically navigating with nothing but emotion as their compass. But Jim Simons did something completely different. He didn't try to navigate uncertainty. He eliminated it. And this isn't just about making money. It's about fundamentally rethinking how risk actually works. Because Simons replaced the entire emotional side of investing with math. He didn't build a better mousetrap. He redesigned the whole relationship between the mouse and the trap, offering a completely new mindset that challenges everything we think we know about markets. Traditional finance is simple. Find good investments, avoid bad ones. Where analysts study companies, read balance sheets, interview CEOs, make judgments about the future, an approach that's dominated for over a century and seems totally logical and human. But here's the problem. It's built on cognitive bias. Emotional interference, systematic error, and these aren't minor flaws you can fix with better training. They're fundamental limitations of human thinking that persist no matter how smart or educated you are. Simons understood something almost everyone else missed. The question isn't which investments are safe, but rather how do we build a system where safety emerges from the structure itself? Philosophical revolution disguised as technical innovation. Because Simons wasn't looking for safe stocks, he was building a system that predicted profit through math and minimized risk at the architectural level, transforming investing from art into engineering, from gut feeling to measurement, from stories to statistics. Think about what this means. In traditional investing, safety is a property of the asset you look for. Safe, bonds, stable, stocks, secure real estate. Safety is something you search for in the world, something you discover through research. But in Simon's framework, safety is a property of the system itself, where individual assets don't matter as much as the mathematical relationships between them, the patterns that govern their movements, the algorithmic discipline that executes without human interference. This is the difference between trying to predict the weather and building a house that keeps you dry no matter what happens outside, between trying to control external events and engineering internal processes that stay robust regardless of conditions. Before we go deeper, let's establish why this matters, because extraordinary claims need extraordinary evidence, and what Simons achieved goes far beyond anything traditional finance thought possible. Renaissance Technologies, the fund he founded, generated an average annual return of roughly 66% before fees over 3 decades. Let that sink in. Not 66% total, but 66% per year on average for 30 years. And by comparison, Warren Buffett, one of history's greatest investors, achieved roughly 20% annually, while the S&P 500 averages about 10%, meaning Simons didn't just beat the market, he operated in a different dimension entirely, achieving returns that seemed to violate everything we thought we knew about what's possible. This isn't theory, this isn't speculation. This is proof that the mathematical approach can systematically outperform human judgment at a scale that defies understanding, and the consistency is maybe even more remarkable than the size. Renaissance didn't have 1 or 2 great years followed by mediocrity. They delivered exceptional returns year after year through bull markets and bear markets, through crises and calm, through tech revolutions and economic chaos, proving their edge wasn't luck or timing, but something fundamental. But here's what makes it even more remarkable. He did it without insider information, without meeting a single CEO, without reading analyst reports, without making a single prediction about any individual company. He proved that the traditional tools of investing aren't just less effective than math, they're obstacles to good decision-making. Sources of noise that hide the signal, emotional anchors that prevent the disciplined execution that generates real return. This influence reshapes how we understand financial success itself, and the credibility comes not from charisma or storytelling, but from 3 decades of returns no traditional investor has ever approached from a track record so extraordinary it forces us to question our basic assumptions about how markets work and what's possible when you remove human motion. Simons made the system itself safe by removing risk from internal factors, specifically human decisions, understanding that the greatest source of risk isn't market volatility or economic cycles. It's the human beings making the decisions, the psychological vulnerabilities that cause even brilliant people to make catastrophically bad choices at critical moments. Every traditional investor, no matter how experienced, brings psychological vulnerabilities to every decision. Fear during downturns that makes them sell at the bottom, greed during rallies that makes them buy at the top, confirmation bias that makes them see what they want to see, recency bias overweights recent events and makes them extrapolate short-term trends forever, loss aversion. It makes losses hurt more than gains feel good and causes them to hold losers too long while selling winners too quickly. Overconfidence that makes them think their judgment is better than it is and causes them to take excessive risks. These aren't character flaws, they're features of human psychology, hardwired through millions of years of evolution for purposes that have nothing to do with modern markets, and no amount of education can eliminate them. They can only be managed through systems that prevent them from influencing decisions. The main goal of Simon's system was to eliminate this human factor, these emotional errors that plague every decision, not by making better humans, but by removing humans from decision-making entirely, at least at the execution level, creating a firewall between psychological impulses and capital allocation. He prevented emotional collapse by delegating decisions entirely to algorithms, creating a system where the most important choices, what to buy, what to sell, how much, when to enter and exit, were made by mathematical models tested against decades of data that executed without emotion, without second guessing, without the paralysis that hits humans during high stress. As Charlie Munger said, it's more important not to be catastrophically wrong than to be smart. This captures Simon's approach perfectly because traditional investors focus on being right, on finding the next Amazon or predicting the next crash, on being smarter or having better info. But Simon's focused on not being catastrophically wrong, on building a system that couldn't make the errors that destroy capital, that couldn't fall victim to psychological traps, that couldn't get swept up in manias or paralyzed by fear, that simply executed based on probabilities and evidence regardless of how it felt or what stories dominated headlines. Think about 2008 brilliant investors running major banks and hedge funds, people with decades of experience and Ivy League degrees, people who'd succeeded for years, made catastrophically wrong decisions because they were using human judgment in situations where human judgment fails systematically. They fell victim to groupthink, to this time is different, to inability to imagine scenarios outside their experience, to cognitive dissonance from having their whole career built on assumptions being challenged. But algorithmic systems don't have these vulnerabilities. They don't panic when everyone panics, don't get greedy when everyone's greedy, don't rationalize bad decisions to protect their ego, don't fall in love with ideas or defend positions just because they advocated for them before. They simply execute based on statistical patterns tested across decades and multiple cycles, patterns that persist precisely because human psychology doesn't change even as markets evolve. This is why investing isn't gambling. It's systematically eliminating risks. And there's a crucial distinction. Most people miss gambling is accepting risk for potential reward, walking into a situation where you know the odds are against you, but hoping luck favors you this time. Whereas systematic investing is identifying risks, quantifying them mathematically, and engineering systems that minimize or eliminate them while capturing returns that persist across thousands of iterations. A gambler walks into a casino knowing the house has an edge, but hoping to get lucky. A systematic investor builds the casino, ensuring the edge is always in their favor, understanding any single trade might lose, but the system as a whole generates positive expected value when executed consistently. Simons understood markets aren't random. They contain patterns, regularities that emerge from millions of participants, each with their own biases, each responding to information predictably, each making the same psychological errors humans have made for centuries. And these patterns are invisible to human observers, too close to the action, too caught up in narratives and emotions, too influenced by the same biases that create the patterns, but they're detectable through statistical analysis, through rigorous testing, cold mathematical examination that strips away stories and focuses purely on what the data shows. Once detected, these patterns can be exploited systematically with precision, not through intuition, but through algorithms that execute without emotion, that size positions based on statistical confidence, not gut feeling, that cut losses mechanically rather than hoping for recovery, that take profits by predetermined rules rather than getting greedy. Although Simon's system is high-tech with supercomputers processing massive data in real time and algorithms identifying invisible patterns, statistical discipline lies at its foundation. This isn't about AI making magical predictions or computers having insights humans lack. It's about rigorous testing, identifying patterns that persist across different periods and conditions, position sizing based on confidence from statistical analysis, risk management that prevents any single trade from causing catastrophic damage. The mathematical approach Simon's pioneered doesn't just apply to high-frequency trading or quant funds with billions in technology ordinary investors will never have. It applies to every investor, including those planning retirement, because the principles are universal, even if implementation differs. Eliminate emotional decision-making by following predetermined rules. Rely on statistical evidence rather than intuition or stories. Diversify systematically by ensuring exposures are truly uncorrelated, not just feeling diversified. Build systems that prevent catastrophic errors, that keep you in the game long enough for compound returns to work, that ensure you never make the mistake that causes permanent capital loss. By analyzing traditional pension strategies from a mathematical perspective, we can identify 5 essential investment types for capital preservation and income. And these aren't exciting. They won't make you rich overnight, won't give you stories for dinner parties, but they're mathematically grounded approaches to avoiding catastrophic errors that destroy retirement, to ensuring you maintain purchasing power for 30 or 40 years, regardless of inflation, crashes, or upheaval. First, inflation-protected treasury bonds, specifically TIPS. These provide guaranteed real return, meaning your purchasing power is protected regardless of inflation. And while returns are modest, typically 1 or 2% above inflation, the certainty is absolute, no credit risk, because they're backed by the government, no market risk since you can hold to maturity and get exactly what's promised, no liquidity risk because the government securities market is the deepest in the world. Just mathematical guarantee your capital maintains purchasing power. This is the foundation because it provides certainty that lets you take calculated risks elsewhere. And the elegance of TIPS is they eliminate inflation risk, the silent killer that erodes purchasing power, so gradually many retirees don't realize what's happening until too late. Second, quality dividend stocks, not growth stocks where you're betting on future earnings that may not materialize, not speculative plays hoping for buyouts, not hot stocks everyone's talking about, but established companies with long histories of paying and increasing dividends, companies that survive multiple recessions and cycles, that proven they can generate cash flow regardless of conditions, because these provide both income you can spend without selling shares and inflation protection, because dividends tend to grow as companies increase earnings and maintain commitment to returning cash to shareholders. Third, short-term corporate bonds, not long-term bonds exposing you to interest rate risk where rate changes cause mark-to-market losses, even though you eventually get principal if you hold to maturity, and not junk bonds exposing you to credit risk where you accept lower quality for higher yields, but risk default and permanent capital loss, but investment-grade corporate bonds with 1 to 5 year maturities, providing income above treasury rates with minimal interest rate sensitivity because short duration means rate changes have limited impact, and acceptable credit risk because you're only buying companies with strong balance sheets and stable cash flows, extremely unlikely to default. The discipline is in duration management and credit quality. You're not trying to maximize yield by extending maturity or lowering standards. You're trying to generate income while preserving capital and maintaining flexibility, ensuring if you need to sell before maturity, you're unlikely to face significant losses. And the logic is short-term investment-grade bonds provide attractive risk-return trade-off, yielding significantly more than cash or short-term governments while carrying minimal interest rate risk and very low credit risk, making them ideal middle ground between tip safety and stocks' higher expected returns but greater volatility. Fourth, real estate funds, specifically rate providing commercial real estate exposure without concentration risk and a liquidity of direct ownership, without being a landlord, without needing large capital for diversified portfolio, because real estate provides both income through rents that tend to increase with inflation and potential appreciation through property value increases, and the mathematical approaches in diversification, not betting on single property or city or sector, but owning a slice of hundreds of properties across office, retail, industrial, residential, healthcare, different geographies, smoothing idiosyncratic risks while capturing systematic returns. The advantage of rate over direct ownership mathematically is diversification liquidity because you can sell shares instantly rather than waiting months to sell property. Professional management, tax efficiency, because rate must distribute most income to shareholders. And by including rate, you're ensuring exposure to an asset class with low correlation to stocks and bonds that provides inflation protection and generates income, all while avoiding risks and hassles of direct ownership. Fifth, and finally, a cash volatility buffer. This is what most investors overlook and advisors undervalue because it doesn't generate returns, just sits earning minimal interest, seeming like performance drag, but it's mathematically crucial. Holding 1 to 3 years of living expenses in cash means you never have to sell stocks or bonds at a loss during downturns. You can wait for recovery. You can rebalance when others panic by buying stocks when they're cheap rather than being forced to sell them. You can avoid sequence of returns risk that destroys so many retirement plans. The main goal of this 5-component system is avoiding being forced to sell at a loss during downturns and minimizing sequence risk because retirement math is brutally unforgiving. If you retire at market peak and experience poor returns your first few years, you may never recover even if markets subsequently perform well because you're withdrawing capital during the downturn, permanently reducing your asset base, turning temporary market decline into permanent purchasing power loss. And this sequence risk is the hidden danger most people don't understand until too late. This is where traditional pension strategies fail. They focus on average returns over long periods, showing projections that say if you earn 7% yearly for 30 years, you'll have this much. But retirees don't experience average returns. They experience specific sequences, and sequence matters enormously. Experiencing 30% decline year 1, followed by 30% gains years 2 and 3, is mathematically devastating compared to those returns in reverse, even though average return is identical, because first scenario, you're selling shares when they're down 30% for living expenses, permanently locking in losses. Whereas second scenario, you're selling after they've gained 30%, preserving capital base. Financial success depends not on emotional decisions, not on finding the next hot stock or timing markets perfectly, not on being smarter or having better info, but on boring-looking yet mathematically grounded systematic discipline, on following rules even when they feel wrong, on maintaining diversification, even when one asset class dramatically outperforms, and you're tempted to abandon your plan and chase performance on rebalancing mechanically by predetermined schedule rather than intuitively based on market feelings, on controlling what you can. Cost, taxes, behavioral errors rather than trying to control what you can't, market returns, cycles, geopolitical events. This is Simon's revolution applied to personal finance. You don't need to be smarter than the market. Don't need superior information or technology. Don't need to predict the future or time cycles. You need to build a system preventing you from being catastrophically wrong, a system keeping you in the game long enough for compound returns to work, a system removing the human factor and replacing emotional reactions with statistical discipline, with rules proven to work over decades across multiple cycles and environments. Consider the mathematical power if you simply avoid catastrophic errors most investors make. Panic selling during crashes, chasing performance by buying whatever did well recently, failing to rebalance and letting winners become too large, paying excessive fees that compound against you, trading too frequently, incurring unnecessary taxes and costs. You'll outperform the vast majority without making a single brilliant decision, without finding a single undervalued stock, without predicting a single market move, simply by not making mistakes that destroy returns. What matters in retirement isn't having $1 million. It's having purchasing power to maintain your lifestyle for 30 or 40 years, regardless of inflation, crashes, or upheaval. And this requires fundamental mindset shift from accumulation to preservation, from maximizing returns to minimizing regret, from exciting to boring, from intuitive to systematic, from believing you can outsmart markets to accepting the best strategy is simply not making catastrophic mistakes. Simon's proved the mathematical approach can generate returns that seem impossible. That replacing human judgment with algorithmic discipline can produce results that violate everything we thought we knew, but the deeper lesson isn't about achieving 66% annual returns. It requires resources and infrastructure ordinary investors will never have. The deeper lesson is the same principles that let Simons dominate can help ordinary investors avoid catastrophic errors, eliminate emotional decision-making, rely on statistical evidence, diversify systematically, maintain discipline during volatility, build systems, keeping you in the game regardless of short-term market movements. This isn't gambling, isn't speculation, isn't hoping your investments work out. This is engineering, mathematics, building a system, removing risk, by eliminating internal factors causing most investors to fail, specifically the human tendency to buy high and sell low, chase performance and abandon strategies right before they work, panic during downturns and get greedy during rallies, make catastrophically wrong decisions, exactly when emotions run highest and rational thinking is hardest. The mindset Simons pioneered replaces all this with cold mathematical logic. Patterns exist in markets because human psychology is consistent and predictable. Patterns can be identified through statistical analysis and rigorous testing. Patterns can be exploited through disciplined execution. It doesn't waver based on emotions or narratives. Systems can be built generating returns while minimizing catastrophic loss probability that survive and thrive across all environments because they're not dependent on any particular scenario, but rather on consistency of human behavior and persistence of statistical patterns. For the average investor, this means accepting investing isn't exciting. It's boring. It's rebalancing on schedule quarterly or annually without deviation. It's dollar cost averaging, regardless of headlines or market levels or your feelings about whether stocks are expensive or cheap. It's maintaining allocation, even when every instinct screams to abandon the plan, even when friends brag about returns and whatever's hot while your diversified portfolio looks stodgy and underperforming. It's trusting statistical discipline will outperform emotional intuition. Over the decades you'll spend in retirement, decades with multiple bear markets and crashes and crises testing your resolve and making you question whether your plan is working. Simons never looked for safe investments because he understood safety isn't found in the external world. It's engineered into the system itself. It's not a property of assets, but of processes. Not something you discover through research, but something you create through discipline. And while we can't all build Renaissance technologies, we can all adopt the mindset that made it possible, viewing investing as an engineering problem, not an emotional journey, as systematically eliminating risks, not hoping to get lucky, as a discipline rewarding boring consistency over exciting speculation, because in the end, investors who succeed aren't the ones making exciting decisions or having best stories. They're the ones building systems, preventing them from making catastrophically wrong ones. And that's a lesson worth far more than any hot stock tip or market timing strategy could ever be. A lesson meaning the difference between comfortable retirement and financial stress, between maintaining independence and becoming a burden on family, between living the life you planned and compromising on dreams because you ran out of money. The revolution Simons brought isn't just about technology or math or algorithms. It's about recognizing the enemy isn't external, not market volatility or economic cycles or geopolitical events. The enemy is internal, our own psychology, our tendency to make errors or to rely on intuition instead of evidence, emotion instead of math, stories instead of statistics. And the solution isn't becoming smarter or more knowledgeable or better informed. The solution is building systems preventing our psychological weaknesses from influencing financial decisions, systems forcing us to do the right thing even when it feels wrong, even when every instinct screams to do something different. Because in the long run, over decades of investing and retirement, the discipline system will always outperform the brilliant individual lacking that discipline. And that's not just theory or hope. It's mathematical certainty proven by 3 decades of extraordinary returns from Renaissance and by countless studies showing the returns investors actually receive are far lower than the returns their investments generate because they buy and sell at wrong times, driven by emotion rather than logic.